As our participants are logging in, let me begin by welcoming everyone to our quarterly economic and market update webinar. We will also be holding a quarterly financial planning webinar in the coming weeks, generally about 6 weeks from now. And we'll be sending out reminders to our clients on that event, but you can always see information about these issues on our website, amrfinancial.com. We will be recording the webinar, so your participation implies consent. And as a compliance reminder, opinions are subject to change and information has been derived from sources thought to be reliable. And be sure to tune in to our radio program as we give updates as well through our podcast on radio show. And we will have some additional disclaimer language at the end of our presentation today for additional compliance information. Let's jump to the next slide. I'm Chris Boyd, and I'm the founder of Asset Management Resources. And I'm joined today by Brian Regan, our firm's Chief Investment Officer, who will be leading the bulk of our program today. Brian, thanks for getting us started. Why don't we jump right in and talk about the agenda, what we're looking to cover today.
Yeah, so Chris, you're going to lead our 2022 review, and then I'm going to talk a little bit about the four-stage pandemic economy that we've had. I wanted to include that largely because I like to think in periods of 3 years at least, and 2022 is just one singular calendar year. I also think it's informative for what we can expect going forward. That's going to lead us to seeing that there is a normalization in the economy going on right now, which generally means falling inflation. And we're going to see how that affects our fixed income outlook, how that affects our domestic equity outlook. And then, of course, we're going to talk about whether or not we see a slowdown or a recession. And then, quite frankly, whether or not it matters. And then Q1, we're going to talk about all the takeaways that we have from this presentation at the end.
Excellent. Well, let's jump right in and talk a little bit about 2022, which was certainly a difficult year for investors. There's no getting around it. Brian's got a great theme here throughout the program to talk about tough conditions. We're going to make the analogy of the skiing that Brian has in his newsletter that you'll be receiving shortly.
Yeah, one of the good things about making these presentations, Chris, is you get to incorporate your own hobbies. So
yeah. But it certainly has been tough conditions when we look at what happened last year. The NASDAQ composite, the tech-heavy sector, 32% in the negative. The S&P 500 down 18%. International stocks down a little less than that at 16%. Even our fixed income investments, judged by the aggregate bond index, the market as a whole, when we look at bond investing, down 13%. This is extraordinarily unusual to have the kind of forces at play that really drove a lot of these actions as to why the markets were down so significantly. The Dow Jones down a little bit less, a much smaller index. We'll talk a little bit about what drove a lot of these prices, these percentages down so significantly this year. Let's jump ahead. So one of the major issues was the war in Ukraine. At the start of the year, Russia jumped right in to give us a lot of anxiety in the market with their invasion of Ukraine. They seem to think they were going to do this very briefly and move through this without much resistance. And of course, that's not been the case. One of the consequences of that was the impact on oil. And we saw oil prices spike at the time. They've come down since then, and it's been a different story over time, but the initial impact was a shock to the markets. Another one of the stories of last year we can derive some lessons from was looking at the Prime Minister, Liz Truss, and in her short tenure, 44 days, she proposed some significant deficit increase and some tax increases, and markets responded pretty sharply to that. This had reverberations felt around the world, and the era of endless government debt and deficits is under scrutiny, and markets are suspect. So the market responded, and this is helping to accelerate. At this point in time, stocks moved below their June lows, and we saw lows in the September-October time.
Just one small correction. She proposed dramatic tax decreases, not increases.
Sorry, decreases. Did I say increases?
I said increases. Yes.
Yeah. So another variable was the crypto collapse. We've had so many inquiries over the year or two about cryptocurrencies. There's been a lot of attention over the last couple months on the fraud that was FTX rather. But all the major companies that you might look to, whether it's exchanges or currencies themselves, have all seen dramatic declines in their pricing, a lot more scrutiny. Brian, you've talked about this on our program many times, but you think that this has a lot to do with pulling a lot of the risk, that is, say, the excess willingness to take risk. There's a lot of excess cash. It's been driving some of these assets that maybe not worthy of the price increases they've had, and it's taken some of that oxygen out of those opportunities.
Right. It's not surprising that when excess liquidity goes away, that the most speculative of assets, falls dramatically, which is the case here.
Yeah, and so it became, this is one of those things where people often look at certain asset classes for, get rich quick opportunities. We've been advising against that in this particular case when thinking about crypto and so forth. That doesn't mean there may not be future benefits of the technology that may come with that, but it's certainly not an asset class without extreme risk. And of course, when there's asset classes like that are going down, it draws people to pull money from other resources, and that can also facilitate downdrafts in equity markets. Another variable that happened last year was what was going on in China. And, had been this zero COVID policy where it had been very restrictive, very limited. And China has talked about changing that policy and more easing that zero COVID policy. And their market has simply responded dramatically, which definitely helped the foreign market performance, international exposure. The more international exposure, if you had a particularly Chinese stock, we saw a big reaction as a consequence of that change in policy perspective.
Yeah, I just want to add, I think you can think of the year a lot in stages, right? Maybe the first half of the year was more negatively impacted by Russia-Ukraine. And then the third quarter was more impacted by the Liz Truss debacle. And the final quarter was, defined by a lot of this kind of good things that started happening. And
yeah, that's a good point.
The end of the zero China policy, where we've seen a rapid increase in the stock market here in the fourth quarter and into the first quarter. And you'll see, when we get to the U.S. Federal Reserve here, that, rates also started to normalize.
Well, I think this is the big driver that, we have to pay attention to throughout 2022. When it comes to what happened in stocks and what happened in bonds, there's no question that Fed policy was a huge part of this, the answer to this question. And, what was going on was the Federal Reserve was trying to tackle the rising inflation and keep it from getting out of hand at a faster pace and for a longer period of time. hate to use the word unprecedented, Brian, but the level of increase and the rapidity of increase in the Federal Reserve Fed fund rate was exceptional. And the consequence is it has had a pretty significant impact on both stocks and bonds in an effort to slow the economy.
Yeah, we could break down those other items into quarters. This one is pretty significant out throughout the whole year, right? It's been the inflation and the reaction of the Federal Reserve to inflation has been weighing on risk markets, throughout the entirety of the year, with the exception a little bit in the fourth quarter, where we see that 2-year, the orange line, and the 5-year start to normalize, despite the Fed continuing to raise rates, which I think is the prelude to the stock market reacting the way it has in the last few months.
So let me turn things back to you, Brian.
Yeah, I think Chris did an excellent job summing up 2022. I do want to go back and take a longer view of things, though, because we often say that we want to take a longer term approach. I often say that I want to take at least 3 years, 3-year look at things. And the reason why I say 3 years and not longer is basically that's the amount of time I think I can get people's patience. Much longer than that, I think you can lose it. But I think the longer the time horizon, the better. Now, interestingly enough, we've been in this pandemic economy for about 3 years. So I think it's a good way to look back and see what happened, see what was different, see what drove the markets in hindsight. And then I think when you get to the data towards the end of this 4-stage pandemic economy, when we get to stage 4, you'll see what's likely to affect the markets going forward. So this is inventory to sales ratio for U.S. businesses. So basically, when this chart spikes, that means that there's not a lot of selling going on, and there's a lot of excess inventory on shelves. And that's exactly what happened at the beginning of the pandemic, right? You couldn't go out, you couldn't buy things, stores weren't open. This is stage 1. This is the panic. And what we saw was the CPI reacted dramatically. We had a deflationary environment that was quite scary. I think we all remember it pretty well. It's probably going to be stuck in our minds up there with some of the greater events in world history. The stock market reacted as well. We've dropped about 33% in a couple months. So that was the panic. Well, then we got the heat, and the heat was we had a ton of stimulus. The Federal Reserve backstopped essentially everything. We had unemployment insurance raised. We had stimulus checks paid out to people. We had SBA loans. We had payment protection program. We had everything that people could imagine come out, and to the tune of trillions of dollars in spending and support from the government. And what we saw was that big spike came down dramatically. And, we couldn't create things as quickly as we could sell them. And the price index, the CPI, rose in reaction to that. And at first this was, welcome. Remember, this is a year-over-year measurement. So if we see something spike to 5 when the prior year was 0, that's not necessarily a bad thing. We're higher off of a much lower level. So that was, at first a very good thing. And the stock market reacted. So we came off that low and screamed much, much higher. And everybody was happy about this in 2021, the second half of 2020 and into 2021. Well, that all changed in 2022. And it's just a coincidence, but fairly remarkable that it happened basically on January 1st of 2022. That's when the shortage started, stage 3 of the pandemic economy. So what do I mean by the shortage? Well, we had the heat. The heat was when we had too much inventory and we're sold it all down. Well, people didn't stop buying things, but we weren't producing anything. People weren't working and producing, and we had shutdowns with other countries. We had tariffs with other countries. The economy was essentially too hot. We demanded more goods than we could create. And that led to shortages. And that led to a spike in CPI that we all know too well. And that led to the rout in the stock market that we saw in the first half of the year. But now we're in stage 4, and this stage 4 is we're coming off the very bottom of that shortage, right? We're starting to see this line tick up to more relatively healthy levels. We're not there yet, but it's on its way. And what's going on? Well, the CPI is reacting, and we just got another very, very low PPI number. It was negative 0.5. The expectation was negative 0.1 today. So inflation is coming down rapidly, and that's going to be the theme of what we can expect going forward based on the charts that we're going to review. And the stock market has actually ticked up a little bit. There was a June low, and then we technically made a lower low in October. Following some of that stuff about Liz Truss and crypto that Chris was mentioning in the first part. But there was some signs that wasn't a real low, as a lot of the breadth of stocks weren't making new lows. It was the index was making new lows, but the breadth of stocks looked a lot healthier. And since then, we've actually stormed back, to the tune around 15% since that October low. So what does this normalization mean? Well, it essentially,
I just want to commend you. I think that the perspective on the pandemic is really important because it's so impactful on what's happening now, and that's a really good way to break it up and to make sense of how this is affecting us now. So anyway, I just wanted to offer that.
Yeah,
nicely done.
So what does normalization mean? Well, essentially it means falling inflation from this very high level, right? And I'm going to show a series of charts here that I call the mountains. And I call them the mountains because they all show a peak and then a fall off to the other side. And quite frankly, I'm shamelessly sticking to my theme here about one of my favorite hobbies of skiing. And we'll see this, throughout the presentation. So here's the first mountain, oil. We saw Chris already mentioned this quickly, so I'll go over it quickly. But it spiked right after the Ukrainian invasion. It stayed high, up until the summer, kept rising through the summer, but it's fallen dramatically and round tripped. It's actually below where it was pre-war levels. This is a big one, wages. I moved the mountain a little bit to the right from that peak because similar to what we saw on the CPI and earlier charts, year-over-year changes from a dramatic low aren't necessarily bad things, but we are seeing, wages fall from a peak of around 11% down to 6%. Normally, historically, we're around 4.5% to 5.5%. More importantly, at 6% here, where we have fairly significant real wages. So, if depending on how you view inflation, I believe we're closer to around 3.7% right now. That's a fairly significant real yield, which gives optimism for a quote unquote soft landing that we'll talk about later in the presentation. So rent growth, also big spike after the pandemic. On the backside of the mountain here, we're skiing down pretty quickly. The December annualized growth rate was actually negative. This has a big lagging effect in CPI. So the fact that rent growth is slowing down dramatically is not yet included in the CPI. And the reason for that is the CPI tries to capture rents actually paid. And this rent growth is about new leases. So there's a dramatic lag effect over time that it'll be captured in the CPI, but it isn't yet. And that's why one of the big reasons why people think, most analysts think that CPI is actually much lower than the stated 6+% rate. Commodity index, again, see a big spike after the war and a fall. And this includes oil and corn, but it also includes things like copper and aluminum and lumber. And I think we all heard the stories of, especially lumber. I think it had double peaks where you couldn't source it. It was incredibly expensive. I think those days are behind us. I could put a freight chart up here as well that would show something similar. We had backups at the ports. We no longer have backups in the ports. It's a thing of the past. So there's a lot of good news here on the inflation front. Now, this is an interesting chart from Fundstrat. What they do is they take these numbers on a 3-month basis, and then they annualize it, and they say, okay, those numbers year over year, they're not really accurate because they're not capturing a lot of these things, or it was coming off a very, very high base or very, very low base. What is it realistically going to be 12 months from now? And they got core PPI at 2.69%. It's probably much lower than that after today's reading. I haven't done the math, but I almost guarantee it. and the core CPI at 4.18%. And I believe that's likely lower after the last CPI reading as well. So that means that's where I kind of get that 3.7% where the market's coming in. My guess would be that we're going to hit the under on that for 2023. And the reason for that is because I think, if we do lose 1 million jobs, which the Fed is serious about, then you're going to have more deflationary pressures. And it's hard to see that the trends that are already going don't continue. And if we're at 3.7 now, you let the rent come in, you're going to be below that with time. So let's talk about fixed income. These are groomed slopes. If you're a skier like me, I like groomed slopes. They're easy on the knees. You don't have to worry about taking a spill. It's generally a good time. You can go really fast and you can enjoy yourself. So, you might be saying, well, Brian, everything you just said about groomed slopes is not the experience that we've had in 2022. Quite frankly, it wasn't the experience you had in 2021 either. If you don't remember, our bond funds were net positive in 2021, but the aggregate bond index was negative. And we had back-to-back negative years in bonds, and that's only happened a handful of times. This chart shows a market between 1941 and 1981, where the 10-year Treasury rose throughout the whole time, from after World War I into the 80s, and then after that, we had a big bull market in bonds. We can see that we have a handful of negative years in there, despite rates rising the whole time. But then those negative years are often followed by very, very good years. 1969, for an example, kind of stands out there. We had a negative 3.2%. And then the following year, bonds were plus 17%. I'm not saying that's going to happen, but what I am saying is just because we had a bad year or even a bad 2 years doesn't mean that we're not going to have a good 2023 in the bond market. In fact, what I do believe is mathematically true, that we're more likely to have a good year because yields are higher. So your interest payments or your accrued interest has more ability to cover any capital losses.
Before you move on from that slide, Brian, I think it's important to make the point, the reason that you've selected this period of time, and just maybe elaborate on that, because you look at this slide, the reason you're talking about this period in time has to do with the interest rate environment.
Yeah, the reason why I selected this period of time is that blue line. That it's the interest rates are going up from 1941 to 1981. And despite all that, there's mostly positive years of return in the bond market.
Following this, we went into a prolonged period of declining interest rates, whereas, we may be in a period of rising interest rates. So some lessons to derive from that. Just thought that was relevant to your commentary. Thanks.
Yeah, I think what's probably difficult for most people is, each one of these green bars represents 12 months, right? Yeah, 12. Yeah. And 12 months to a lot of people is a long time. And investing is just not, and that's a struggle. Like we had a difficult 2022. So it's hard to talk about the long term. But I think, charts like this give us some perspective on why we need to think about the long term. So we have a very interesting yield curve. The federal government can borrow for 5 years for cheaper than it can borrow at 6 months. That is not normal. And as you can see, a year ago, that yellow line shows that that wasn't the case just 1 year ago. So what does this mean? Well, in general, you want to target the spot that is highest. You want to get paid the most for the least amount of risk. It's very simple. But at the same time, we acknowledge that as that blue line towards the end, towards that 5-10 year starts to go down, there's a chance for some significant capital gains. And well, we want to take advantage of both of that. So what you can do is, what we can do is we can find ways to extend our duration to try to take that capital gain. So what I went out and did is I tried to find the asset that gave us the most reward for the least amount of risk. And what that looks like right now is emerging market government bonds. And normally, I wouldn't have said this 6 months or even a year ago, But the reality is that the dynamics of the dollar, which most impact the credit losses that you might have in emerging markets, have changed. And I believe that we're more likely going to be correlated with the 10-year Treasury now, which is what we're trying to target, right? We're trying to extend duration intelligently here. The only way this doesn't make it into the portfolio is if the bull market that's happening in this asset right now goes so far where we can't get into it the way we want to by month end. And we don't want to do any trading until month end because we don't want to have any wash sales on the tax loss harvesting that we did at the end of 2022. So we're in this kind of sticky position where we would love to get into this. It's doing really well, but you know, the tax laws might not allow us to do it until it's too late. And then if that's the case, then you know we're going to change our thought process. But we have 2 weeks. The problem is it's moving very, very quickly. You know, this morning, for example, it's up 1.5%. So does that mean we're going to get crazy with our duration? Absolutely not. We're gonna get even a more exaggerated barbell. We talked about how you want to target kind of the fattest part of that curve, where you get the most bang for the least amount of risk. So that means we want to average between 2 and 2.5 years. That's where you're getting the most return. You're getting 4.3% return on a 2-year, and you're not getting nearly that much on the 5-year, and you're taking more interest rate risk on the 5-year. So how are we going to do it? Well, we're going to take a lot of cash-like positions, which is what JPST is. It targets about 6 months on the yield curve and then we're going to offset that with some longer term ones. And the average is going to be around 2.5 years. So what we're trying to do here is we're trying to get the interest payments that we're going to get from rising interest rates that the Fed has told us that they're going to do through the short-term bonds. And we're also going to try to get the capital appreciation that we expect to get with falling longer-term bonds. Good thing is, you know, generally speaking, the yield to maturity is around 5+% on these things. So going forward, we have much more opportunity in the fixed income space. Just when you think about it that way, right? If you expect, you know, 5% over annualized return over the next, you know, call it 5 years, you know, it makes your portfolio less risky for, you know, this kind of a similar amount of return that we've been experiencing for the last 5 years. So what have we been doing over the last 6 months? One of the things that we've been doing to offset our underweight in equity has been to be overweight in high yield. And that's been so far, you know, a good move for us. That purple line, as that goes higher, that means these bonds are getting cheaper. And we got into it around that spike there in July. So we can see that we've done fairly well on it as the purple line has come down. But we still think it's relatively elevated, and it's especially elevated considering that orange line continues to tick up. So what you get paid on your high yield bonds is a combination of that orange line plus that purple line. So we're getting close to 9% on our high yield bonds right now, and I think that's a relatively good value considering where you know, corporate balance sheets are right now. So this guy is having a great day on the groomed trails. I feel relatively optimistic about fixed income. If you're feeling you know, rumbles in your tummy about that, I don't blame you. I feel similar, you know, fears, but sometimes you got to go by the numbers, and the numbers tell us this is a decent place to invest right now. We should feel pretty good about it. You know, there is a recency bias and a hindsight bias that every human being carries with them, and it's hard to forget the recent past. But you know, let's go back to that fidelity chart and look at the perspective of a longer time frame and what happens after, you know, a tough market in bonds. Usually it's a very good thing. You know, usually it brings sunny skies and groomed trails to us. So let's talk about the equity outlook or stocks. You know, it's a little bit different than the bond market, as you'll see towards the end here. I don't think it's necessarily groomed trails. I think it's you know, a struggling slog down the hill, maybe for a novice skier. But it's much better outlook than it was a year ago. So you know, let's look at generally speaking, the stock market outlook. we're at the long-term mean at 16.5 times forward earnings. So just there, if you're only going to look at PE, you got to feel pretty good that a lot of the froth looks like it's come out. I'm of the belief that this number actually should be higher than the long-term mean for a few reasons. First of all, interest rates are still lower than they were in 98 through 2002 by a significant margin, actually. You would talk about 10-year treasuries around 6% back then. So that's almost twice where they are now. Second, we're more of a bites and bits economy. We're more of a subscription-based economy where cash flows are more predictable. And that's an important aspect. Typically, analysts will pay up for a predictable stream of cash flows as opposed to a company that is more volatile. If you just want an example of that, look at U.S. Steel versus Costco. Costco is a subscription business that's fairly predictable. U.S. Steel is an extremely cyclical business. U.S. Steel sometimes trades at a PE of 1, and Costco rarely trades for a PE under 25. So that's just one example of how that might work. So the bear market for the stock market, the bear view for the stock market is very clear. The bear view believes that earnings are too optimistic and they have to come down. So I did a little math. I looked at, hey, look, what's the expectation for earnings for 2020, Q4 2022 and 2023 and 2024? And that's what you see on the left-hand side. And those earnings give at the forward multiple that we see today, we're around 41, 4,200. That's pretty optimistic, right? I think we got to be pretty happy with 4,200. We're not there yet today. I know the market's up right now as I speak, but I don't think we're quite there. So let's shave off 7%. Why did I choose 7%? That is typically the average amount that an analyst is overly optimistic. If we shave off 7%, we're at 3,900. If we go a little further and shave off 10%, we're at 3,762. So call it 3,800. So our range is really between 3,800 and 4,200. We're not significantly under that. We're not significantly over that. This is what we would call a fairly valued stock market. So we also often get the question, well, if it's a fairly valued stock market, then you don't expect, the stock market to progress. Well, that's not necessarily true. Look at the analyst earnings in 2023, they're expecting $230 a share. In 2024, they're expecting $253 a share. So if I put that 16.5%, 16.5 times forward earnings estimate on that $253, you're going to get a number that's much higher than 4,200. So that's how the economy grows over time and the stock market grows over time and why we're optimistic. And this brings us to constantly preaching stocks are long-term assets. So I took some basic assumptions based on long-term averages. I actually made them a little bit more conservative. We have a trailing multiple today of about 17.27, or trailing multiple when I did this, because the stock market was at 3,800. It's a little higher than that today. I took the dividend payout that we currently have. I did a return on equity of 10%. And I just calculated what would it be if all this turned out to be the case over the next 10 years. Well, you see the stock market would be almost double, and we'd have a total return of about 9%, about 2% from dividends, about 7% from price return. 9% a year, I think most people would take that. That's actually below what the long-term average is. It's a lot below what the last 10 years have delivered. Even after the bear market we've just experienced, the S&P 500 has delivered more than 12% a year on average for the last decade. So, if we just stick this out for 10 years, it's not unreasonable that we're going to get a double in the stock market. In fact, I would expect it. Now, what happens if we have a dramatic decline in the stock market? So we have, in this case, I have in year 0, the stock market at 3,800. In year 1, it falls to 30.57, which is a 20% price decline, which is, not a coincidence. I chose that because that's exactly what happened last year. We had a negative 18% total return in the S&P 500. We had a 2% return from dividends, a minus 20% return from price returns. Now, what happens to the expected return after that 18% decline? Well, it goes up 50 basis points a year. We went from 9% in a year before we had that giant decline to 9.5% per year. So what does this all mean? Well, what it means is the ideal situation is you want to find stocks that have already fallen that have declined, that will last for the next 10 years, that will continue to grow, which will achieve that ROE of about 10%. And that leads me to, this holding that we have in almost every portfolio, which did not have a good 2022, which is MGK. It's a mega cap growth holding. And you can see the holdings on the left-hand side. We have Google, Amazon, Microsoft, Apple, NVIDIA, Home Depot, MasterCard, Costco. I don't know for sure if these companies are going to be around for the next 10 years, but it's my best bet at any companies in the whole market that these will survive. And maybe you have a different opinion on that, but and that's always debatable and always a healthy discussion. But these are the biggest, healthiest companies that we have. And what have we seen? Well, we've seen their valuations on the right-hand side on that chart fall at least 20% across the board for some of these big names. I got Apple, Microsoft, Amazon, and Alphabet there. So we've had the decline in them. So based on those previous charts we saw, there should be the most opportunity in them going forward. Which is why that we are holding this holding as a preference right now. So, at 16.5 times earnings, we're at the long-term average. I think that could be a little higher. As a long-term investor, we see some very good stocks that have fallen down in value. So, there's reasons to be more optimistic, but we're certainly more cautious. If that price to earnings ratio was at 10, and these earnings pictures were a lot different, then maybe I would have that skier with the bright sun going down the groomed trails. But this guy's making it down, slowly but surely. He's going to make it, and he's also got the most room to improve too, which is something to consider. So we're going to have a slowdown or a recession. This is something that is certainly debatable. I don't think anybody has a clear answer, but what I will say is that the Federal Reserve and the market are completely at odds with each other. The Federal Reserve seems like they almost want to cause a recession. We are seeing inflation come down, and they haven't signaled in any way, shape, or form that they're willing to slow down slow down or stop their increases. And well, they have slowed down their increases, but they haven't shown any reason to stop increasing or reverse. Now, this is what the market expects. The market expects them to reverse it at the end of 2023. So the market thinks, hey, look, inflation is not a problem. We've achieved a soft landing. Stop it. And if they don't stop it, well, they believe they're going to have to cut rates later in 2023. So you can see that this has Fed funds going to 5%, which is another 50 basis point raise, which the market thinks they're going to have to cut, in 2023 and 2024, which is why the 2-year and the 5-year have been falling. So, what do I think based on that data? I think we're going to have a mild recession. That's my base case. And I think we're going to have a mild recession because the Fed wants a mild recession. I think they want to see 1 million jobs lost. I think they want to see the unemployment rate go from 3.5% to 4.5%. And this isn't just my guess. This is what they tell us, right? Now, you could debate whether that's necessary or not. I would say, from what I see in the inflation data, it's probably not necessary, and the market agrees with me. But I do think they're going to cause a small recession. I think they were late to the party raising rates, and they're going to be late to the party lowering rates. Now, here's the good thing. Just because we have a recession does not mean the stock market's going to fall. In fact, the stock market tends to bottom before GDP and before earnings. So even if you expect earnings to go down, it's quite possible the S&P 500 has already priced that in, which is what we showed in that previous slide when we talked about earnings and cutting earnings. These charts, a little difficult to read, but if you spend some time staring at them, if you want to pause the screen, if you're watching this on a recording, what you'll see is the bottom of the S&P 500 happens well before the bottom in earnings and the bottom in GDP, and oftentimes the bottoming of payrolls, and all these different types of recessions.
Brian, I think that's a serious concern for most of our clientele and listeners, that So I'm glad you brought it up, and hope you can reiterate. This is an important point that it's very possible, almost likely, that we'll have a recession, and that doesn't necessarily mean that that is bad for investors looking ahead, that they'll have another bad year, which is what I think most investors are concerned about. It's not to say that there's any absolute with this, but I saw an American Funds publication where they said it's somewhere around average that markets anticipate by around, on average, 7 months advance of what's happening economic direction. So, to your point, it doesn't necessarily mean that markets will go down, even if we do have a recession. The general expectation, I think, is that if we do have a recession, it's likely to be short and shallow. The issue of earnings you mentioned earlier is, I think, at the heart of that question, though. And your numbers, when you were talking about that range of what might be the expectation for the market, you did anticipate some discounting of the possible earnings, and assuming the same multiple. That is that your base case, that you think it's likely that markets will kind of be steady, or do you think that they will not steady, but not necessarily end anywhere positive, or do you think we're likely to have some favorable surprise of some kind because of earnings improvements or whatever?
Well, even if we do that -7%, which I think is my base case, we're going to do fine, right? That's a 3,800 fair value for the S&P 500. We lose 7%, fine. We lose 10%, be down a little bit more than that, which means we're a little bit elevated from fair value now. But 1 year does not make a stock market, right?
Right.
The stock market is priced based on many years. They're long-term assets, as we showed before. So if you think that we're going to have if you were to tell the market that earnings are going to be half what they are in go down 50% from what they were in 2022 and 2023, but they're going to be 200% of what they were in 2022 and 2024, the stock market would go up. It's not solely based on 1 year expectations. It's based on many years of expectations. The market would see right through that first year and recognize that they'll make it up plus some in the year after that, and the year after that. And that's why we have such a high multiple on these things, right? So if you were to just pay $1 into the stock market, you wouldn't actually get a return on, you wouldn't get that dollar back in earnings for 16 years, right? If there was zero growth in the stock market. The reality is there's growth in earnings. So you're going to get that dollar back much quicker than that, right? And I think that's often lost on people when they are concerned about what's going to happen in the next 3 months or the next 6 months. And quite frankly, I think it's lost on a lot of stock market participants, which is why I encourage people to think in at least 3-year increments. It's very easy to look back 3-6 months and say, I shoulda, coulda, woulda. And it's much harder to look back at the last 3 years and said, at this given time, this was my fact set that I make a reasonable decision. And then given my fact set today, what's a reasonable decision going forward? And that question is a lot different than, what should I have done last year based on what I already know? The decision is based on the facts I have today. What's my best decision going forward? And that's what I would encourage how to think.
You're going to talk about this momentarily, but just in that sets up why you've structured the portfolios the way they are, where we're a little underweight equity, but we do have fixed income. We do have some equity like fixed income in the mix. You're trying to get opportunities not only from stock, but other places as well.
Well, I think there's a better risk reward in fixed income today, quite frankly. So that's where we want to try to find our opportunity, right? I know that the knee-jerk reaction is to try to just be defensive because we just had a tough time. Right? We just had a tough year. But with that tough year gives cheaper prices, especially with bonds. I mean, objectively cheaper prices. These are contractual obligations to pay us back. That stocks aren't contractual obligations to pay you back. They don't have to pay you anything. Contractually, you could own a business that doesn't make any money. They're not going to pay anything. Bonds aren't like that. They have to pay you. I mean, they can go into default. They can get cheaper in price, but in time they have to pay you. So it's easier to step in and take a risk in a place like that. So given that, let's get into the takeaways. As usual, and we stressed this at the beginning of 2022 too, and I really mean it. If you feel any unease about short-term risk, let's discuss your risk profile. And why is that important? Because we want to think about things in the longer term. And I think we've stressed that a couple ways. First, in that long-term bond chart from Fidelity with the green bars and the blue line going up. Also with the stock charts, it shows that there's actually more opportunity when the stock market goes down. We want to think about the long term. So if you're uneasy about short-term risk, you're probably taking too much risk, and let's discuss your risk profile. First of all, the big thing is inflation is normalizing, right? We went through a really turbulent 3 years, and it's been really, really hard to stay ahead of things as things have been changing so quickly. But we have been in this kind of 2-year inflation period, and that 2-year inflation period is not unprecedented. We have had some unprecedented things happen in the markets, but this inflation period is not unprecedented. It happened after World War II. It's fairly, a reasonable economic circumstance based on what we went through. But now we're on the back end of that, so we should be thinking about the back end and not necessarily thinking about how high inflation is or was. We had back-to-back negative returns for bonds. It's extremely rare. But it makes pricing very interesting here for the 3rd year. Like I said, we got groomed slopes. So where I want to take risk is in the fixed income part of your portfolio, not necessarily in the stock part of the portfolio. And how are we going to do that? Well, in emerging market debt, it looks like a very good risk reward opportunity. We're getting about twice that in yield that we're getting from treasury assets. They are riskier, but they're about on average 1.7 times riskier, and we're getting 2 times the return. So that is by definition, a nice risk return opportunity. So expected earnings may falter, right? That's the bear case in the stock market. We could have a recession. But when I did this presentation prior to the stock market rallying, about 5%, which has happened pretty quickly, a 10% decrease seemed like it was priced in around 3,800. So let's keep that in mind. It's not, we know it could happen, less likely for further exaggerated multiple contraction. So what happened in 2022 is we went from a forward multiple of 21 down to 16.5 as interest rates went from 0 to 4.3 on the Fed funds. Now, we know that the expectation is that Fed funds are either going to get cut or probably stay at best stay at 5%. For the rest of 2023. And that without a significant rise, it's hard to think that we're going to get a significant fall in the multiple. So that's why I'm, keeping that multiple at 16.5% when I do that analysis. So we're less likely to get that headwind that we had in 2022. A recession's likely, but a recession doesn't have to be like the pandemic. It doesn't have to be like the financial crisis. It doesn't have to be like the dot-com bust. There have been in the past mild recessions. And I do think that's what we are likely to have. I mean, I say likely because, I put probabilities on all these things. And for some reason, if something breaks in the market, like a Liz Truss moment, well, then we're more likely to have a debt crisis. And that's something that you want to keep your eye on, particularly when we're investing in higher yield debt. So that's something that we're actively looking for. But we're not seeing anything like that right now, anything really to be concerned about. So I do think a recession is likely, as we're going to see more layoffs and more people in the United States will lose their jobs. But the market believes that the Federal Reserve will pivot when that happens. And I agree with them. The stock market, most importantly, it bottoms before earnings and GDP historically. So just because somebody rings a bell and says that we're in recession, does not mean the stock market will drop. It will either drop before it again, or you could say, hey, look, it already fell. I mean, the Nasdaq fell 30% in 2022. Maybe we put it in the bottom, and reasonably you can look at the math and say, hey, it looks like it's very possible that we did so. So, I think I'll wrap it up with that and take some questions.
If you'd like to ask a question, there's a couple of ways you can do that. The easiest way, there's a Q&A button, and you can take the opportunity to jot in a question if you want to do it in writing. If you'd like to be called on and have a verbal question, you can raise your hand and we will unmute your line. Brian, one of the things that we haven't really talked about in this presentation are the unexpecteds. There's worry about debt ceilings. There's worry about foreign actors, creating unexpected events and uncertainty kinds of circumstances. Maybe just take a moment to talk a little bit about these aren't necessarily, what we're planning as far as our base case, but how would you characterize how we're positioned relative to some of those kind of concerns we hear from time to time from clients?
Yeah, so let's talk about what the debt ceiling is. It's a ridiculous political football. The Congress has already agreed to spend money. They spent the money, and now they need to raise the debt to pay for that. And it's used as basically a weapon to force the other party to do what they want to do at any given time. Janet Yellen's come out and said that they will run out of money. I believe they said by April if the debt ceiling isn't raised. There's no reason it shouldn't be raised. It always is. It always has been raised. There was one instance, I believe it was in 2012, where they got so close, the S&P actually downgraded the United States debt. And it got so close, and what happened? Well, treasuries actually rallied. It's weird. It was even though the debt that was in question to be paid by the U.S. government, it was still considered the best credit in the world, and despite the concern, it rallied. So, from a short-term perspective, there will be, especially with the rebalance, a significant amount of cash-like instruments and treasuries in your portfolio, which should weather any kind of debt ceiling concerns. Now, when it comes to foreign actors and things like that, well, we have seen this year in 2022 that a foreign invasion can have huge consequences on the market. And it's really hard to guess when that's going to happen, right? And they're very, very rare. I don't think most people want to go to war, but I would say the same thing. We are going to be positioned very significantly in cash and treasuries, more prominently in cash-like instruments. If this is something you're truly concerned about, I think this is partly a financial planning question, Chris. I think, what do you have in your emergency fund? Should it be bulked up? What kind of risk are you taking in your first bucket beyond your emergency fund? Maybe it's too much. You should ask yourself those questions if those things are really, really nagging at you. I think it goes back to, one of those takeaways I said, where I said, reevaluate your risk preference, right? We say it every year, and we really, really genuinely mean it. If you're worried about short-term events or something that could happen, or, speculating about, X, Y, and Z, then I think you should definitely give us a call, and we should talk about, the amount of risk you're taking.
Excellent, thanks. I don't see any questions. Just last chance, if you have a question, raise your hand so we can call on you. Otherwise, Brian, is there anything else you want to summarize or finalize?
Well, hey, look, it's no doubt been a difficult 2022. I think we're getting to the end of a historic period, the pandemic economy that we went through in that 4 stages. And I think we're going to be moving into a normalization period, which I will welcome, when the economic data actually makes sense and you can believe it without having to massage it and make your own numbers because things are moving so quickly. And that's that'll be a welcome difference to me. Another welcome difference to me in the market is the bond yields. We can make a lot more headway to reaching your financial goals if we can invest in assets and get a return without taking a lot of risk, than if we have to juice up the risk in order to try to meet your goals. And that's also exciting for me. And I know, as usual, I just want to thank everybody for their trust. We are doing our best to achieve risk-adjusted returns. Risk-adjusted doesn't mean, no risk. It means we're trying to make the most, most dollars per unit of risk. And so, again, thank everybody for their trust.
Brian, one last question that did come in from Kathy. She asks, the average length of a growing economy is 38.7 months or 3+ years. The average recession lasts for 17.5 months or so. Besides layoffs, companies are reducing capital expenditures. How does this affect recovery?
Well, I guess I challenge your data there on the length of an expansion. They're typically between 7 and 10 years, and recessions are normally between 6 and 1.5 years. So I challenge that data a little bit. Maybe there's some outliers that are making that different. But if you just look at between the financial crisis to the pandemic, that was 12 years. If you look between the dot-com bust to the financial crisis, that was about 8 years, 7-8 years, depending on how you measure it. So, I challenge that data a little bit. Reductions in capital spending and cuts to employment. I mean, that's how recessions start. That's how it happens. And then what you'll see margins expand as people do more with less, and the stock market earnings will recover. And then all of a sudden, there'll start to be, discounts, and discounts lead to, margin pressures, but it also leads to decreasing inventory, which causes people to need to hire again. And when you hire again, you're off to the growth cycle again. Recessions are normal parts of the economy. And as long as there's free flow of credit, then you don't have as big a concern. It's easy to say if you have a job, but if you if you lose your job, the situation's obviously different. But yeah, credit is the number one important thing. And as long as we don't have some kind of credit crisis, it should be relatively shallow and recoverable.
Hey, for what it's worth, I happen to have something in front of me that was from the Capital Group indicating the average expansion since 1950 is 69 months, the average recession around 10 months. So that's helpful. In any case, Brian, great job with giving some perspective to us all for this. It's challenging when you have a year like 2022 to stay the course, but we're making adjustments with the way we handle the active allocation. And as you said, if people have concerns about whether they're on the right path, we're happy to talk to them about their overall planning and put their investments in that context, see if we've got the right structure, any changes that might be called for. You can always reach out to us through our website, amrfinancial.com, or give our office a call. We have a couple of numbers for that, but you can certainly reach us toll free, 866-771-8901. Thanks everybody for being with us today. If you have any concerns, reach out to us. Thanks.